Inflation is coming down nicely.
Is the market going to crash? Everyone's always thinking the market's going to crash. Bob Singh has said, watch this space. Hey, Bob, how's it going?
Very well, Shiv. How are you?
I am very, very good. Sitting here in my home office, looking out the window at this horrible weather that we're getting at the moment. But at least we know it's autumn, isn't it?
I know lots of leaves on the tracks, I think. So train strikes will happen again, no doubt.
It's about the time of the year that we have train strikes. In fact, that actually leads us very, very nicely into this podcast. We have train strikes, and there's a lot of people that are commuting, and then they get frustrated that they have to commute and stuff. And what we're always trying to do with property is trying to create kind of like a secondary income stream, a passive income stream. That means that, maybe they don't have to work as hard. Maybe they don't have to, they can cut down from 5 days a week to 4 days or 3 days, or maybe they can retire early and enjoy their life rather than just having to, work all the time. You are an expert in this field. You've been doing this for a long, long time. And I would like our viewers to get the benefit of your experience in this podcast. So I'm going to ask you a few questions, and it's going to be really about what's been happening in the markets. What is going to happen, do you think? Because you've got a lot of experience, and I think that experience, because you've seen this before, you can kind of give us some advice around that. Also, I want to go into what are the pitfalls to avoid right now, because mortgage companies are being a bit sneaky, and we need to make sure that as people that are investing, we want to navigate around those tactics that they have. And then finally, I want you to answer the age-old question, which is always on everyone's lips all the time. Anytime I speak to anybody about property, they always say to me, but is a crash around the corner? So that's all the stuff that we're going to cover. Let's get straight into it. So Bob, can you just introduce yourself first of all and tell us a bit more about your experience in this market?
Sure. Bob Singh, I'm the owner of Chess Mortgages. We have an office in Hillingdon, but we do cover the length and breadth of the UK. I've been advising ever since 1993, I think, which is 30 years now.
Wow.
And before that, I was in banking for 10 years. As an assistant manager in the bank's insolvency division.
So you know this area very well from both sides of the...
Both sides, yeah, because I was involved on the recovery side, and I saw the lending side as well. And obviously, arranging mortgages for 30 years. Yes, I've seen a few cycles in my lifetime. It's a long career. We specialize in mortgages, remortgages, buy-to-lets, development finance, bridging finance, and commercial finance. So we do a lot of things, plus a few bells and whistles. So when a client comes to Chess Mortgages, they're probably going to get rounded advice in all areas, to be honest with you.
A holistic service, absolutely. That's exactly what they need. So the first question I'll ask you, Bob, then is, can you give our listeners a bit of an overview of the current state of the economy and how that's affecting the mortgage markets at the moment?
Okay, the economy is still fragile. GDP growth was only 0.2% last month. We're hoping that will not go into negative, because what we don't want to see is a recession, because that leads to poor sentiment, lack of confidence in the market, and that could lead to further property prices falling. Inflation is coming down nicely. Will it come down this month? We're not so sure, because obviously now we have a second world war happening, and that's increasing petroleum prices, and that might have a cancelling out of of inflation that would have happened otherwise, because food inflation is down. So had this war not happened, we definitely would have seen a further decrease in inflation. Let's see what happens, but the outlook is good. The 5-year money markets are really, really positive about rates falling in the long term. We're now seeing residential rates at sub 5%, which hasn't been seen for a long time. And the average 2-year fixed rate is also well below 6% now as well on the residential market. There are products obviously available that are designed, to attract people, but we'll talk about that a little bit later. But certainly the economy is doing well. We've got an election next year, so let's see what the autumn budget or the autumn statement brings. And if that has anything positive, from a housing perspective, that can only be good for the market.
Yeah, and you said that the economy is fragile, but the outlook is mildly positive. If we go back a year ago, take us from what's happened a year ago to what's happening now.
Okay, a year ago, 5-year money was 1%, and buy-to-lets were 2.5%. Then we had that disastrous budget from Kwasi Kwarteng and Liz Truss, and that sent the money markets into a bit of a tiz. And consequently, rates just spiraled out of control. 7 and 8% became the norm, which was a big, big shock for people. And anybody coming out of a fixed rate at that time would have been greatly, greatly affected because they would have gone from a very low margin to a huge margin. Now, thankfully, Kwarteng was cast aside, and then Jeremy Hunt came in, and then since then the ship's been somewhat stabilised. We've seen a growing confidence in the money markets and the policies that are now being put into force. And inflation shot up and went into double digits. That's now sort of halved. And the Rishi Sunak's personal pledge is to halve inflation. So we do expect inflation to fall from what was close on to 11% down to roughly 5% by the end of this year. Yeah. So that's a positive move. And that itself will lead to further base rate cuts. At the moment, base rate is 5.25. If the meeting
are we at the top right now, do you think?
Maybe one more increase.
And when you say one more increase, are we thinking about going from 5.25 to 6 or 5.25? You think just to 5.5 or something like that?
To 5.5. I think the Bank of England does not want to take any risks.
Yeah.
So 2nd of November is the next meeting, I think. So it was a close call last time to hold those rates. And because prior to that, they've been going up pretty much every month, 0.25%. So it was a very, very close call to hold rates at 5.25. The vote was 5 to 4. Now, if inflation does come down, then maybe we'll hold again. Maybe some prospect of a further increase of 0.25% if the inflation figures aren't as good.
And actually what you're saying is, I mean, look, regardless whether it's November or whether it's January, the point is that we're expecting that we're kind of almost reaching the top. We may be at the top, but we're almost reaching the top. In the next 3 months or so, 4 months or so, we'll probably at the top. And then after that, slowly, the rates hopefully should start coming down, assuming that the rest of the economy continues in the direction that it's going in at the moment. Is that what you're saying?
Absolutely. We've seen the increase and then we're now at the top. So if you can imagine tabletop mountain, you're either rising on one side and then you're plateauing for a period of time. So there will be a period of plateau because inflation, if it comes down quickly, then that will be the signal or the impetus for the bank to reduce base rates. And then when it does start reducing, we think the rates will then start to come down rather quickly. But GDP figures, employment figures, all play a big part in the decision-making process when it comes to base rates because the bank does not want to stifle any sort of recovery either. So
we're on a tightrope, basically, is what you're saying. Because you said earlier in this conversation that we don't want to go into a recession because that gives you negative sentiment. But on the same token, we want to keep inflation coming down. It can't be increasing too quickly in terms of GDP. We need to keep it at about 0% thereabouts so that we can continue the inflation coming down, we can keep the economy on track. And so at what point do interest rates actually then start to come down?
At what point? Well, 5-year money is already falling because these rates are pretty much decided by the swap market rates, the forward money market rates. Now they're coming down nicely because the expectation is rates will be, 3 or 4% in a couple of years.
So let's just expand on this point because this is a really, really important point, which I think a lot of people, especially people that are new to investing in property, they don't understand at all. In fact, even people that have their own residential properties. Actually, what you're saying is that the mortgage rates that you see in the market are not necessarily dependent on the Bank of England base rate. So regardless of whether we're at the top, it's going to be more increase or it goes down from now, it's not dependent on that. It's dependent on what you said is swap rates. Just give us a very, very brief explanation of what swap rates are.
Swap rates are the cost of money, basically. It's what the banks expect the cost of funds to be in a future point in time. And it's basically a financial instrument between two organizations, one offering to lend at a fixed rate and one on a variable rate.
The difference between a swap rate and a Bank of England base rate is that the swap rate is looking at the future and the Bank of England base rate is looking at right now. So actually, when we're looking at mortgages, because it's looking at borrowing money over, let's say, the next 5 years, what we're looking at is the swap market because it's the future market. Is that right?
Absolutely, yeah. The banks don't lose because they've hedged their bets on fixed rate. When they lend on a fixed rate, the banks rarely lose. When you take a fixed rate, don't think the bank's doing you a favor. They're not. Yeah. They're not. They will gain. They will make money out of that deal.
Make money.
No question. But this is where good mortgage advice comes in because at least if you do take a fixed rate, you should also understand the alternatives available to you, so you're making an informed decision.
I'll come on to good mortgage advice in a second. One thing that people constantly ask me is, should I take a fixed rate or should I take a variable rate? And if I take a fixed, should I take a 2-year fixed or a 5-year fixed? And one of the things that I always say to them, and I'd like your opinion on this, is that, obviously you need to think about your own attitude to risk and where you are and your finances, etc. But at the end of the day, don't spend too much time worrying about it, because the bank has baked in all of whatever it thinks is going to happen with all of its hundreds of employees and analysts. They've already baked that into the price of the rates. So, of course, if you want to have security over how much you're going to pay, then don't go for a variable rate. But ultimately, whether you go for a 2-year fixed or a 5-year fixed, the bank has already baked in what they think the rates are going to be. So either way, you're probably going to be more or less the same.
Yeah, basically, yeah. The cost of money over a 5-year period is roughly 30%. So, whether you pay a low rate or a high fee, it's still going to cost you roughly the same on a 5-year window. But the banks have a duty to lend responsibly. They will only lend you what they think you should be borrowing, rather than what you can afford to pay back, because they have more modeling in the background. As you rightly say, they've got access to so much data about cost of living and everything else. So when they plug that into their back systems, the computer tells that this person should be lent XYZ amount.
Of course, yeah.
For security or whatever purpose. Sometimes you're forced to take a fixed rate when you really, really want something else.
Yeah.
Particularly in the buy-to-let market.
One of the things that I've seen, whether you can cast some advice on this, we were talking about mortgage advice. The rates are coming down, but there are some lenders who are charging higher rates and some lenders who are charging lower rates. How can they charge such difference in rates? One person's charging 5%, the other person's charging 4.5%. It's
mortgage dressing, as I call it. Yeah, it's the equivalent of window dressing in shops. Basically, because of the ICR calculations.
What's ICR?
Interest coverage ratios for buy-to-lets. Okay. Now, because they have to meet those ICR calculations, and the rents haven't gone up as much as the rates have gone up, they're having to design products that fit the ICR. So they're having to lower the rates artificially and bump up the fee so that the case can actually pass the ICR test and be approved. And for that to happen, you've got to take a 5-year fixed rate to get the maximum lending. The rent's going to be at the right level. And if you're stuck not charging your tenant the full market rent, that could backfire when it comes to remortgaging, etc. So, there's a lot of background mathematics that we do before we actually arrive at a product. But we're seeing fees up to 10%.
Yeah. So actually, just to be clear, what you're actually saying is that banks need to lend money. That's how they make money. They need to get the money out the door. But because of these ICR calculations, which are somewhat some sort of like regulation in the industry, it means that the way they're getting around that regulation is by having rates that are lower, but fees that are higher. And I suppose in some way that's obviously not a good thing. If you compare it to what it was a year ago, that's not a good thing. But is this just the way it's going to be now?
No, as soon as rates get down to the 3s and 4s, that should change.
Okay.
This is a temporary thing that they're having to, put square pegs into round holes. I think it'll be temporary. I think there'll be as soon as rates come down, because rents having gone up now substantially over the last year, are unlikely to come down unless there's more property available. And there's a shortage everywhere, not just in London, but everywhere. There's a shortage of rental property. So rents will, I think, now stay high. Rates will fall. And landlords should be a lot happier in the long term.
So when you say rents should stay high, help me understand why rents not just will stay high, but will continue to increase as well. What's the mechanism behind that?
It's basically supply and demand shift. There's just not enough property available. There's, 20, 30 tenants for each property waiting. The demand is, simply there. It's too much. So landlords are able to charge more, not because of demand, but they have to charge more because their own mortgage payments have gone up.
Yeah.
So it becomes unviable for them to charge the old rents when their mortgage payments doubled and trebled. So factors combined, because now landlords are fixed in for 5 years, for example, they're not going to lower their rent for 5 years.
Talking about your ICRs that you were talking about earlier and the data that's available, one of the things that I find interesting is the difference between London and the Southeast and the North. The ICR ratios might still be the same, but because the rents compared to the mortgages are much higher in the North, it means that a lot more properties sort of tend to hit that requirement. So I suppose ultimately what I'm trying to say is what I've found is that if you're looking to get a buy-to-let property, you're much more likely to get the mortgage approved at a specific loan to value in the north than you are in the south. Is that about right?
Definitely, we're seeing that a lot. Yeah, because it's very hard now to make the numbers fit in the south.
Yeah.
Everyone is migrating north or the Midlands or Leeds or
Yeah.
Manchester way. The cancellation of HS2 might have upset a few landlords because that would have been maybe beneficial for the Midlands and
Mm.
the northwest. But yeah, we see it a lot. We're seeing a lot of people buying in Leeds. We're seeing a lot of people buying in Nottingham, Leicester,
Yeah.
Birmingham, Wolverhampton. Sort of towns like that, which are university towns as well, because the demand is there.
I think this news about the HS2, sometimes, we've got to remember that the newspapers are there to sell news. They're not always there to give us the news. They're just there to sell newspapers. When I read into like what's actually happening with the HS2 being cancelled, they said, yes, we're going to cancel the HS2 because obviously we had all this money that we're going to put towards it. Now we don't have the money anymore. But what they are still going to do is use half of that money to upgrade all the rail network. So what that means is, I mean, I give you the example of Leeds because I know the numbers off my top of my head. Currently, it takes 2 hours and 20 minutes to get from London to Leeds in the train. With the HS2, it was going to take 1 hour and 20 minutes, so substantially reducing the time. 1 hour and 20 minutes. Now that there's no HS2 there, even though there's no HS2 there, I should say, because they're upgrading the rail network, instead of being 2 hours 20, it's going to be 1 hour 40. So it was going to be 120 with the HS2. It's now 140, which is not that much longer if you think about it. So really, I think that the news about the HS2 as a headline, obviously it gets everyone excited. But when you read into it, you realize that actually direction of travel is to continue to increase infrastructure between London and the north. And that's just the way that we're going.
Yeah, I think on the news I saw one survey done in Manchester about the cancellation, and the average man on the street couldn't care less whether it was going ahead or not. It's a government infrastructure project, and it was a big one. It did or would have created a lot of jobs, but that's now not going to happen. But that, as you say, that money now will be spent in rejuvenating the old stock. Yeah.
And actually, another difference between London and the southeast and the north that I recently saw was the average wage compared to the average purchase price. And it said in the southeast, specifically in London, it's something like 16 or 17 times the average wage. The purchase price of a property, average purchase price, is 16 or 17 times the wage. Whereas in the north, we're talking about much more like 6 or 7 times the wage. And I think that there's a lot of people who think, oh, well, I don't know if property is the right thing to do. It's going to crash because the affordability isn't there. And I definitely see, on one hand, the affordability is being stretched in London. But on the other hand, when we think about the north, where it's only 6 or 7 times compared to 16 or 17 times in the south, there's a huge amount of way that the rents can increase.
Yeah, those figures are actually quite real. For first-time buyers to buy in London is very hard at the moment. We're doing a lot of mortgages in the Midlands because people are prepared to relocate or get jobs over there. The north-south will level up. People will realise what they're buying is bricks and mortar. When it's your main home, you should never see it really as an investment. It's because you're never going to be able to sell it to gain from it. It's a roof over your head. It's long term. It's for the family. Why would you want to pay 3 times the price for the similar property in London when you could have an easier life up north? And I think people are realising that property ownership is nice, but not having to pay too much for it.
I think someone told me this once: a mortgage means a loan until you die.
Yeah, mort in French.
Mort, yeah. Yeah, so I was like, wow, okay, fair enough. So yeah, you can have a nice house, but as long as it's not, paying it off until you die.
On the back of that, actually, people are taking 35 and 40-year mortgages in the south.
Of course. Well, I was going to say that's the other tricks that the mortgage companies do. I say tricks. I mean, they're not tricks. They're ways of accommodating the people that can't afford it. Is they say, well, we'll just extend the mortgage term from 25 years to 35 years or 40 years. And it means that because you're paying it over a longer period of time, your rate can stay the same and you're not going to be forced into, selling your house or something, isn't it?
Yeah. And, people are realizing that it's not all about working until you're dead or, earning until you're dead. People want a work-life balance. They want space. And I think this is where the main driver now, because people still want, they want gardens and they want outdoor space. They want to work from home, so they want an extra bedroom for the office. Well, the differential in pricing allows them to buy that property for a lot less than they would in London. So that's a big driver at the moment.
People want to live a life, and on that basis, then, with that in mind, give us the answer to two questions. One is the market going to crash? Everyone's always thinking the market's going to crash. Is there a chance the market's going to crash? And what does a crash even mean? You know, when I say, "Oh, is the market going to crash?" What does that mean?
Crashes, I think, if it falls more than 10% in a year. But I think we're sort of going to have a soft landing. I think prices are down. eServe said September prices fell 2.9% last month. The nationwide survey is out this morning, which I've not actually looked at, so I apologize. But I think that will reflect a similar figure. You know, we are seeing a downward trend, of course, because, you know, who can afford 6% mortgages these days? Not many people. You know, buyers are negotiating well. They're sort of managing to lop off up to 5% of the asking price. So that's had an effect on prices.
Yeah.
Estate agents are being a bit more realistic in their asking prices because they know that you know you can't be bullish in this sort of market. So all these factors, all the headlines, you know, do manifest themselves into a price reduction era.
And when you say a soft landing, do you just mean basically that, in your opinion, you think that things are just going to kind of slowly work themselves out?
Yeah, because what the market is waiting for is a turn in interest rates.
Yeah, so the Bank of England base rate, that's what you're talking about.
Yeah. As soon as that starts to come down, inflation starts to come down, because there are, I can tell you from experience, hundreds of people, thousands of people waiting on the sidelines to get back into the property market as soon as they can feel leveling off and rates are affordable. Because 5-year money is 5%.
Yeah.
As soon as that comes down to 3.5% and 4%, it's
everyone's jumping in.
well below. It's well below the 25-year average, and I think people will then even start to look at 5 and 10-year fixed rates because having seen the events of this year, they don't want to be caught out again. So you know, I can see longer-term products being much more in favour than they have been in the past.
Okay, cool. And then the final question for you, Bob, is when is the best time to buy property? Tell me. So everyone's been waiting for me to ask you this one question. You know, you've been in the mortgage market for a long time, but that means that you've been from the sidelines, having looked at the property market. You've been through cycles of this, so you know. Tell us.
The best time to buy a property is as soon as you can afford one, because the market is dynamic. It's always moving forward. If you manage to save up the deposit for that particular property and you can afford it, buy it. Because if you wait for the market to hit the bottom, chances are you're going to miss the bottom, and you're going to catch it on the way up again. And as it goes up, you're going to need more deposit. You might need more income to qualify for that higher loan. So you could miss the boat. So I think my advice is, if you can afford it now, numbers make sense, go for it.
Very good. One of the things that we're saying at the moment, Bob, to our clients, and I wonder whether you agree with this, is we're coming up to Christmas. You know, we've just said that it's raining outside and no one can bother to go and do viewings and things like that. So actually the number of people buying, number of transactions tends to reduce around this sort of time. As well as that, the number of people that want to get their property sold increases around this time, because they say, you know, I had this idea that I was going to sell it in 2023. As long as I can sign the paperwork in 2023, then you know, I've ticked that box in my goals list. So there's a lot of people, sellers, who want to do deals this year. There's a lot less buyers. And so as a result, I think there's a really good opportunity to negotiate prices right now, especially because the base rate is high. And at the moment, we don't know whether we're going to have another increase or a decrease. So there's a bit of uncertainty. That uncertainty allows us to negotiate prices. As you've just said, though, once we get to the other side, as soon as there is a drop in that base rate, which may be November, but maybe December, well, not December, but January time, at that time, we'll know, okay, the Bank of England thinks that we're okay. And as a result, as you've said, all those people that are sitting on the sidelines that have been waiting to buy property, they're going to jump in. And also, as well as that, January is always a upturn in terms of transactions, because people have New Year's resolutions. This year, I'm going to buy property, etc. So as a result, I think that come the beginning of next year, where it's spring, January, February, March, that kind of time is usually the time where the market picks up. So I think that we're going to have an upturn in the market. And as a result, if you're looking to buy, I feel, and this is certainly what I'm trying to do right now, I feel that the right time to buy is as soon as you possibly can, because we have the most uncertainty right now. What do you think?
Yeah, definitely by the end of the year. Otherwise, springtime might be too late, because the market will move forward. And as you say, the bank's not going to start to decrease rates just yet.
Yeah.
They will want to see the inflation path firmly on the way down. And as soon as that happens, that signals or allows them to actually start lowering the rates. And it's election year, remember? It's election year next year.
Yes, yes.
So, we're going to see some positive news, I think, for sure.
Yeah, fantastic. And I suppose what you're saying there is we're going to see positive news across the board, but also hopefully for landlords, because the government are trying to win the vote of landlords.
Yeah, let's hope they introduce something, because Section 24 changes have really messed up a lot of high rate taxpayers. And it's no wonder that everybody is now buying into a limited company format for tax efficiencies. But there's a lot more that the government can do for who still own property in their personal names, who are high rate taxpayers. I'd like to see Section 24 abolished. I'd like to see the old system come back, and let's get the property moving, because landlords play a very important part in providing housing on behalf of the government, because they're not building enough houses themselves.
Yeah.
The landlords are buying and investing and helping the government to meet that sort of demand as well. And the government's forgetting that.
Yeah, absolutely. So there you have it, guys. Bob Singh has said, watch this space. It's going to be an interesting time. He's also helped us to identify that if you are looking to invest in buy-to-let property or any property right now over the next 3 months, or maybe the 6 months, if you can stretch it, then that would be the right time to buy. But thereafter, as far as we are concerned, the markets are going to pick up, GDP growth is going to pick up, the interest rates are going to fall, and as a result, property prices are going to start to increase as well. Is that about right?
That's a good summary.
Fabulous. Bob, thank you very much for sitting here with me and talking to our listeners. And also, thank you very much for sharing all of your 30 years of wisdom and experience. It's been a pleasure. Where can people find you if they want to get some advice about their mortgages?
They can contact you, actually. So, or if they want to link with me directly, then just Google Chess Mortgages.
Chess Mortgages.
Yeah, just Google Chess Mortgages. Our website will come up, and then you can email me through that mechanism.
Fantastic. Thank you very much, Bob. Really appreciate it. And I'll speak to you soon.
Thank you, Shiv. Take care now. Bye-bye.
All right.